Okay, here are some comments about the common mistakes that I found in your RCRE1. So let's go ahead and take a look at some of them. So the first thing is, and this was a problem in I think many of the reports. So the value change is not $500,000. It's more like $500 million. So if you said 500,000, you're off by a factor of 1,000. And I think that's because the shares outstanding is actually a number of thousands. It's not a number. So some of you got it correct, but some of you didn't get it correct. So make sure that you don't make that mistake. So you should be very careful that you know all the data that you're using. You should know what data it is before you start using it. The second is a few students had this problem. So they used the share outstanding and the price to calculate the dollar value of the impact. They use the shares outstanding and the price from different dates. So keep in mind that they should be from the same date and it should be from the previous day. A couple of students had this issue. So when they calculated the fundamental beta, so they used the book value of equity in calculating the debt to equity ratio. So you should be using the market value of equity, not the book value. Now in the CAPM approach, most students got this correct. I think there's just I think one group maybe which did not do this correctly. So because you're estimating the abnormal returns on a daily basis, so you need the daily RF. However, in number 7, you're estimating the implied annual change in cash flow. So you need the annual rate of return, not the daily return. So keep that in mind. So there were, I think, a couple of groups which made this error. So the equally weighted value weighted returns, these are market returns. So they are not firm returns. Okay, so there seems to be some confusion. But this is the equally weighted market portfolio, the value weighted market portfolio, and the S&P portfolio. Those are 3 proxies for the market return. There is only one firm, so you only have one firm return. You don't have 3 firm returns. Okay. And then I think one group made this error. So keep in mind, we've been through this when we did chapter 11 and 13. So you have to estimate the beta over relatively longer time periods, between 3 to 5 years of data if you're using monthly data. You should not use a very short time period to estimate the beta because those estimates are not reliable. Now this was a question which was I think common for many submissions. So the question is, we know the market reacted negatively, but was it efficient? So how do we know if the market reaction is efficient or not? Well, in an efficient market, the complete information should be incorporated on the announcement. So if the complete valuation consequence of the announcement is incorporated into prices, then there should be no abnormal returns either before or after. Okay, and so the abnormal return was 0, so that's how we know it was efficient. So keep in mind, so you're looking at the subsequent period returns, and that will tell you if it was efficient or not. The prior period return before the announcement will tell you if there was any leakage of information or not. Now most of you correctly estimated the value change as almost a quarter of the value. Now keep in mind, losing a quarter of your firm's value in one day is not a small estimate. Okay, it is actually a very large sum of money that the company is, large value that the company is losing in just one day. Okay, and keep in mind the share price remained below 40, it remained in the low 30s, so it did not bounce back for many weeks, many days after the event, even though some of you said, hey, see, the price bounced back. No, it did not bounce back. So it was a permanent loss in value. It's not a short-term loss in value. So very few groups actually were able to explain why the loss in value was so large. After all, it is just a negative information about one drug, right? So why would negative information about just one drug have such a big impact? Well, That's because this was the biggest drug for the firm. You could actually see the 10K. One group actually made this connection, and they also showed that, hey, this is this GI disease, that's a very large market. So this is a drug that they already have, but they are just trying to get the FDA approval for a new usage. So it's a new usage for an already existing drug. Okay, and the potential market is pretty big, and this is their biggest drug. So it's not a surprise to see that the market reaction was pretty large. So all in all, I think quite a few groups did well. So they got, 3.5, 4, somewhere thereabouts out of 5. So that's pretty good. A few groups did not do that well. They had a whole lot of these calculation errors and some of these conceptual errors too. So just make sure that you go over the Navistar example also. So this is very similar to the Navistar example.